side by side with you.
Hey, everybody, it's me, Mickie Giacomini. Welcome to Let's Talk Shop. I am so excited about this evening's episode. We've been talking about it for a while now, about bringing you first home buyer tips for first home buyers. And I actually have an expert. She's a loan officer with me this evening, Melanie Overmoe. Woo! And here, let me bring her in right now. Hi, Mel. How are
you? Thank you, Mickie. Okay, I'm trying to get the best picture available here. So I'm coming live to you guys from Nuevo Vallarta, Puerto Vallarta, Mexico, where I've been for the last 3 weeks. And I have one more week left. I got married down here a couple weeks ago, but I live here a couple weeks or a couple months a year and still do loans in Sacramento. I'm based out of Sacramento, and so that's where I'm at right now.
Yep. So even though she's the one in Mexico right now, I know sometimes a lot of you are used to me doing this, but we're tag teaming on Mexico, right? But we are talking about first home buyers in the United States of America. So don't let that throw you.
Yes.
So yeah, absolutely. So Melanie, let's start off by just sort of laying it out. What does it mean to be a first home buyer? And when you hear FHA, what does that mean?
So first home buyer is anyone who has not owned a property in the last 3 years. So if you owned a property, let's say you owned a property and you had a foreclosure or a short sale in 2006, 7, or 8, as we all know, those are difficult time periods in our area, you would be considered a first-time home buyer again. And you could apply and be granted any of the first-time home buyer benefits or programs. FHA is specifically for first-time home buyers and or credit challenged, income challenged individuals. FHA allows for expanded qualifying criteria to be able to get first-time home buyers into home ownership. It came about after the Great Depression, after our grandparents, great-grandparents, great-great-grandparents went through the Great Depression, could not get a home. FHA came about to be able to get those people back into home ownership to create generational wealth at that point.
All right. Thank you. And a lot of people that will be gleaning information from us have actually never bought a home before. So they may not be through looking at that 3-year gap and so forth. So for those of you out there that have never bought a home, it's okay. I know, and Melanie and I both, we work with so many clients that this is so true. It can be very overwhelming, and it can also be a little scary. But that's what we're here for, is to help you understand a lot more about the process so that it's not scary and you know how to get prepared, get organized, and be ready to go. So we're going to take all that scariness out.
Absolutely. So the biggest thing to know is there are first-time home buyer programs available. There are limited down payment programs available, and potentially down payment assistance available programs available. My job is to take your scenario and figure out which one of those is best suited for you and which one you qualify for to get you the best deal possible.
And you know, sometimes my clients that are first home buyers, they will tell me that they're a little nervous about price point and so forth because they are so worried about coming up with that 20% down payment. And so a lot of people think that you need a 20% down payment in order to get a loan. Melanie, can you shed some light on that, please?
Absolutely. That's one of my favorite subjects. So if you search home buying on the internet, most often you're going to come up with needing 20% down. And that's completely false. So on a conventional program, we can do 3% down. On an FHA program, it's 3.5% down. The FHFA, which is the Federal Housing Finance Authority, came out about a month ago and said, we want to make home buying more affordable for our clients. So all of the costs associated with purchasing a home and the interest rate to make things less complicated have come significantly down since the first of the year. So they have things that are called, not to get too complicated, but loan level pricing adjustments. If you went to 100% financing, 97% financing, the rate would be much, much higher. That has been eliminated for many, many home buyers as of January 1st.
Yay! That helps. So hopefully many of you that will be watching this, whether you're watching live or you watch this as a replay, you're understanding there are different programs, different loans, different rates. And so that means different down payments too. So you don't necessarily need to be scrounging to come up with 20% down for your first home. So that's a big one. I know of just so many people, they're just so hesitant to buy that first home because they're like, oh my gosh, I got to keep scraping and scraping to have that 20% down. And it can be very daunting if you're looking at it that way.
Well, in addition to that, as you know, Mickie, we are now in our Sacramento area on most of our homes that are available. We're able to get seller concessions, seller credits to pay closing costs, to pay interest rate buy downs, to pay all of those things to make that house even more affordable. So not only has the federal government made it better, but so has the local market made it better.
Absolutely. And for those of you who are my clients or my future clients, when you're buying a home, those are some of the things I love to negotiate. So
a year ago, we didn't have that. Yep. A year ago, we didn't have that. 2 years ago, we didn't have that. You would have to be overbidding. You would have to pay more. They wouldn't give any concessions. And that has completely changed. So, which actually brings me, Mickie, if I could just talk about this for just a second.
Sure.
Talk about interest rates. So interest rates are not as low as they were a year and a half, 2 years ago. Right. However, the prices were significantly higher then. We couldn't get any seller concessions. We couldn't get any break on pricing. We couldn't get anything from the seller perspective. So yes, rates may be a little bit higher right now, but if you're getting 5, 10, 15, 20,000, depending on the purchase price, depending on the scenario, worth of help to get you in a home. We can get you where we're at right now. And then a minimum of 6 months from now, if rates go down, we can get you into a lower rate.
Exactly.
A year from now, we can get you into a lower rate. 2 years from now, whatever it takes. But getting those concessions, getting into a house now, getting that appreciation on the value is the key to making all of this happen.
Absolutely. We call that marry the house, date the rate. And right now, we've seen a lot of, okay, hang in there with what I'm going to say. We have seen housing prices come down.
A little bit.
Yes. We're actually starting to see them coming back up now. So this is a good time to buy if you're going to buy, right? Yeah, so, so we're seeing that the prices have come way down and now they're starting to come back up. But at the same time, you may be thinking interest rates are higher, but at the same time, like Melanie is saying, if you get into the home with a great price, then you can refinance down the road and get a lower interest rate when they come down, because interest rates fluctuate. They always have, they always will. And I'm telling you,
always will. Absolutely.
My first home, I think we were so excited that the interest rates finally came down from like 10, 12% until they got into like the 8s. And we were like, yes, We thought that was amazing. So, we just got really, it's an anomaly what happened during the COVID shutdowns to see that rate come down to close to nothing. And we may never see that again. I don't have a crystal ball. So don't get hung up on those 2-3%. So,
and we as a public have a very short-term memory, and all we remember is the last 2 years and the 2s, 3s%, whatever that was.
mm-hmm.
That is not historically correct. The
Right.
government artificially bought down interest rates to keep the economy going during the COVID shutdowns. They knew that buying houses, people refinancing, appreciating value was the only way we were going to sustain the COVID crisis.
Oh, yeah.
So now that we're out of that crisis, things have adjusted, that rates are a little bit higher, and yes, the affordability has suffered a little, but if you're getting whatever, like we just said, whatever the credits may be, and a lower purchase price than it was 2 years ago, and you're not competing with it against 50 people, the value is better now than it was then.
Right. Yeah, absolutely. On my Instagram page, I believe a couple months ago, I showed a graphic. So go to my Instagram page, scroll way back, and I have it over the last 50 years of time. I got it from SAC appraiser Ryan Lundquist, and I posted that up. Take a look at that. He's really great at sharing data. So take a look for that graphic. If you can't find it, reach out to me, and I'd be more than happy to share it. It's amazing to see. And more value when you're not having to fight against everybody and their brother for a house that you may not have even ever seen. You're just trying to get it. So it got a little crazy there. So tell us a little bit more about things like cash to close. We hear cash to close. What does that mean?
Cash to close is your total down payment plus closing costs. That are not, let's just say we don't have any seller credits, we don't have any concessions. That would be your total out of pocket expense. A lot of times people will come to me and they'll say, Melanie, I have $50,000, $20,000, $10,000, whatever that may be. My question is that their total down payment or their total cash to close? You should expect 3 to 3.5% of the total fee, total purchase price in closing costs. So I have a deal right now. It's an FHA deal. We're getting seller credit. So seller is literally paying out of their proceeds the closing costs. My buyer is coming in cash to close with their down payment of 3.5% plus the appraisal fee, and that's it. So cash to close is all of the funds needed to close the loan.
Right. So you've mentioned the word concessions, and I know because I'm a professional in the industry, I know what that means, but many people may not know what that means.
I
kind of look at it as just explain it. It's like a credit. So
if your closing costs are, let's just say if your seller, just for ease of math, if your purchase price is $300,000 and you ask for seller concessions of $9,000, the seller automatically takes $9,000 off of their purchase price to give that to you to pay your closing costs.
Yep. It's a beautiful thing.
It's not cash. It's not cash.
No.
And some people do think that. It's not cash. It's just a credit to go towards your closing costs. And your closing costs are going to be, depending on the time of the year and depending on the title escrow company, 3 to 3.5% ish of the total purchase price.
Okay. Hey, before we move forward, I just want to remind people that you are welcome to ask us questions. Put them in the comments below, whether you are here live right now with us, or if you are watching this as a replay, please feel free to put them in the comments. Even as a replay, we do keep an eye on those, and get back to you as much as possible, as quickly as possible. So, all right. So let's talk about applying for credit. I have some clients that they get a little nervous at first. Some of their fears are that they may not have good enough credit to apply, to get pre-approved, to buy a home. So what are we looking at with that?
Okay, so I see this as my job to help people get pre-qualified, pre-approved.
Mm-hmm.
So there's no, I promise you, in the last 18 years I've been in business, there is no scenario that I haven't seen. It's been 450 credit scores up to 850 credit scores. I specialize in credit repair. If it's too difficult for me to do, I can refer it out to, I have a company who does legitimate credit repair.
That's
Um,
important.
and that's very important because a lot of people will take your money and not do anything. And I know
Yep.
that personally because I had it done before I was ever in loans. I know what that's like, but they'll do legitimate. But for the most part, I can run reports, I can run scenarios, I can see what we can do to get your credit score to a place where you need to be. And in addition to that, let's say you have good credit, but let's say that credit score is just slightly short of the next break to get a better interest rate. I
Yeah.
will advise you, like, let's say it's a big difference between a 720 and a 740. If there's something we can do to get you to a 740 to get that interest rate to be better, I'm going to advise you of that. Most often, if I talk to borrowers that have been pre-approved by other lenders and they're just shy, let's say they have a 725 and they could easily get to
Mm-hmm.
740, those
Yeah.
lenders don't ever tell them how easy it would be and what we need to do to get to that next interest rate break. So I see it as my job to get you the best deal possible, with the best credit possible, to get you the best payment possible.
And that is so appreciated. I mean, that can save you so much money just taking care of a couple of things, or maybe it's just one thing that could really boost up your credit score. Oh my gosh, that's tons of money you can save.
Sometimes it's just a couple $100. Sometimes you just need to pay down a credit card, a couple hundred
Mm-hmm.
bucks to the next credit break,
Yeah.
which will save, if you're not putting 20% down, saves you in mortgage insurance, which
Yep.
I'll touch base on that in a second, which saves you on the interest rate, which saves you thousands monthly and annually. So mortgage insurance
Yep.
covers the lender in case you default. So if you're not putting 20% down, you do have mortgage insurance, which can be
Right.
viewed as a bad thing.
Yeah.
However, mortgage insurance rates have come down significantly in the past couple of years. And if you don't have 20% down, then it is what it is, and take the mortgage insurance and refi out of it when you have the opportunity.
Yeah, I think that might be something. If any of you have heard of something called PMI,
Mm-hmm.
so that's what we're referring to. That's what that is. And basically, they're just covering their own behinds to make sure you really do make your payments. So, yeah.
They,
Oh,
they view they view anything over 20% down as a an increased risk to default. So if you don't put 20% down, they're thinking you're better chances of defaulting. Whether that's true or not, and we're not judging, we don't
yeah.
care. This is what it is. So they do charge mortgage insurance, but it's easy to get out of if you have the right advisors, and it's really no big deal.
Yep. Okay, so what about you? You and I were talking recently. We were talking about taxes and all that coming up and all that, and then we were talking about first home buyers and the W-2s and tax returns and all that, and the difference for people, especially like if they're self-employed. And are there any stipulations when you're buying your first home if you're self-employed, or are there any particulars that we should know about?
Self-employed is very tricky. So it's very, very common for me to have somebody that comes to me with an application that says, I make 10,000 a month, 15,000 a month. I'm self-employed. This is how much I make. But then I get their tax returns and they have written off all of their expenses, which trust me, I'm self-employed, Mickey's self-employed, we get it. And in reality, they make, $2,000-3,000 a month. So the thing with self-employed is that bottom line net number that you report on your tax return, and I believe it's like line 31 or 32, that is what we use to calculate income. So if you make 200,000 a year, but you write off $150,000 in expenses, we're going to use that 50,000.
Yeah.
And that's what we're going to use to calculate. I do want to say the caveat to that is there are a lot of programs out there right now that we call non-QM, means they're not Fannie, they're not Freddie, they're not FHA, they're just an alternate loan line that will allow bank statement programs, programs for 1099 buyers, that will allow us to use the gross and not that net income. However, the cost for those loans is significantly higher. You have a higher interest rate and there is a larger down payment requirement.
But the silver lining is that it's still there to help
Absolutely.
those people that are 1099. So,
Absolutely.
yeah.
Mhm.
And I mean, that really
And
helps.
it's a benefit that we didn't have a few years ago, because after the mortgage meltdown of 708, for many, many years, you could only go off of what you put on your tax returns. You had no other alternative.
Yeah.
And now we do have that. So if you have
Right.
15, 20, 25% down, and you're like, you know what, I only claim $20,000 on my tax returns, but I have cash in hand to put a little bit more down, we can still get you a loan.
Right. It's a beautiful thing.
Yes, it is. Yes, it is.
Well, so what about people that aren't necessarily self-employed? What about people that are they work for an employer,
Mm-hmm.
but maybe they've changed jobs? I know that sometimes that's something when I've applied for loans over my lifetime, it's like, okay, well, have you changed jobs recently? That question always comes up. So tell me a little bit more about that.
So that's one of the big things in lending that's kind of an tends to be an old train of thought. Um, if you have had 2 years consecutive employment with no job gaps, even if you change jobs, we can potentially use that income. And I say potentially because post COVID, things have changed with what we call variable income. If you're not, a set number of hours a week, like let's just say $20 an hour, 40 hours a week, every
Mm-hmm.
single week without exception, things can get a little bit dicey.
Yeah.
But in general, as the loan goes, if you've had consecutive employment for multiple years and changed jobs, that is not a deal stopper. It's not going to change things. Yeah. And most
So
people
you can
think if you
all
change jobs, they think if you change jobs, you're dead in the water. And that's not
yeah.
true.
Yay, because I know so many professionals out there that have not bought a home yet, but that's one of their things. They're like, but I just switched to this company 3 months ago. I can't get a loan. Yes,
Yeah.
you can.
It's
You
very
can,
possible.
career changes. So
Mm-hmm.
that's one too that, it's just it depends on your circumstance, but it's
Yeah.
not that it's dead in the water. So just hang in there and go for it. Apply.
And it's
um,
our job as a loan professional, as a mortgage advisor, to let you know what we need. Sometimes when people change jobs for one reason or another, we need 6 months on that job.
yeah,
Sometimes we don't need anything. And being in the same career is no longer a circumstance for your job. Having a solid work history is. The job you're actually doing is not.
right. Yay. So go ahead, everybody. Go out and do what you want to do.
We'll figure it
Choose
out.
the right vocation.
We'll
Yeah.
figure it out.
Um, there are some things that are some different parts of being a first home buyer that oftentimes come up with some of the clients that I work with. And one thing that has come up is because there are different first home buyer programs. There is one program, I believe it's called CalHFA,
Mhm.
and then there's also first home buyers. And so just can you help us remember which programs do the buyers need to take a little buyer's course in order to complete the requirements for their loan
Okay.
program?
So if you're doing conventional financing, which means anything that's backed by Fannie Mae or Freddie Mac, and your loan officer and or me should tell you if that's what you're doing, and you're only putting 3% down, you need to take a first-time home buyer course. That is provided through Fannie Mae or Freddie Mac, whichever one you're using, um, for free. If you're using a Cal HFA loan, which means California Housing Finance Agency, it doesn't matter what type of loan, 3% down, conventional, FHA 3.5% down, doesn't matter. Any of their programs require that you use their first time home buyer education program to be able to get those funds. I will tell you, a few years ago, probably 4 or 5 years ago now, I had a buyer that we were using the Cal HFA to do their purchase. And I sent him the link to the program, which I always do. And
Yeah.
he went out on the internet and found a different first time home buyer program because
Hmm.
I should back up and say the Cal HFA program has a $99 fee. The Fannie Mae or Freddie Mac program is free. At that time, he went online to find a different program, and the free program did not pay the $99 fee that he was required to,
Oh,
and submitted me a different certificate because at the end of the program, you get a certificate of completion.
right. It's
That was a
important. You've
complete
got to get
waste of
that.
time. Complete waste of time
Oh,
because the program we were using would not accept that
yeah.
certificate. It had to be the link to the program that I sent him. So it's really important that you follow the instructions of your loan officer at any point during the transaction
Right.
and use the links that they send you for the first time homebuyer program. So if you're using Cal HFA, California Housing Finance Authority, for any down payment assistance and or closing cost assistance, you have to use their program no matter what.
Yes. And you're not the one making up the rules. Loan
No,
officers are not, your lender's not making up this rule. Okay, everybody. So that's really important that you know that it's the program that's making up the
correct,
rules. So,
correct,
so you
correct.
have to follow the rules in order to get the great benefits that they are providing you.
Yep,
You know,
exactly.
it is what it is. And it's not like you take a 5 hour, 3 times a week for 5 months course at all. It's a quickie. It's a quickie course.
Yeah,
And it's not a long drawn out thing. So
no,
don't be worried about that. If you're hearing, oh my gosh, I have to take a course, never mind. No, 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 no. It's not like
it's not a big
going
deal.
through, yeah, a
I
semester
have
long thing.
I've actually taken them myself to see what my clients have to endure.
Yeah.
The Cal HFA one used to be a legit 8 hours. It's not anymore. But once you finish the online course, then you do I'm going to say in person, but it can be on video, a personal one on one with a counselor from an agency in Sacramento to verify that you understand what you're doing, understand what you're getting into. The biggest thing is they do not want home buyers buying into something they do not understand. And unfortunately, even this day and age, many loan officers are terrible about informing their clients about what they're getting, the cost of what they're getting, and the why of what they're getting. You may not understand everything, but it's important to me that you get what you're doing. You got to get it. And that doesn't always happen. So these first time homebuyer programs, these education programs are designed to help protect you from really bad lenders who haven't informed you what you're doing.
And I want to add 2 cents to that. And that is, for those of you, as soon as you are eligible to take that course, take it immediately. Do not wait till the last second. You can blow your escrow by taking it too late if you don't get it done in time. And I'm just, please, I'm begging you, take that course the first moment you can. Get in, sign up for your course, and take it. Don't wait till the last minute. Please. That's a nightmare.
Certification lasts 12 months. So even if you don't end up buying this house, it will help you when you end up buying the next house. So it's 12 months. I always send it to my clients first thing, right when they get into contract. I want it done the first week and get that certification and get that into underwriting.
I mean, I've just seen where we've almost lost we almost fell out of escrow with one of my clients because of a last second for them to take the course just a few days before we closed. Oh, I was biting my nails on that one.
That's no good. No good.
Do you have any other tips on that as well?
On the first time on the class? No, it's all online. You just do the thing, you get it done. Period. You just do the thing and you get it done. You get the certificate and you give it to me so I can get it signed off from the underwriter.
Right on. Okay. So I also have something else I want to ask you, actually, on behalf of my first home buyer clients. When somebody is a first home buyer and they know that they're going to go through some sort of first home buying program for their loan, FHA, CalHFA, whatever the case may be, are there particular criterias for the homes that they are purchasing? Are there any specifics? I mean, I'm kind of leading because I know the answer to this, but I want to hear from the expert. Okay. You're the loan expert.
So for a conventional loan, that's anything that's backed by Fannie Mae, Freddie Mac, the criteria basically that the house has to be in good working function. You have to have, good floors, heating and air. You don't have to have heating and air, but if you have it, it's functional. The things that are in the house are functional, and you can't have any major pest or termite damage. Conventional is pretty lenient on what they require. FHA, VA, USDA, any of the government-backed programs are a little bit more strict. FHA does require that the heating and air actually work, the hot water and cold water work, a dishwasher works, a garbage disposal works. All of those things are actually functional. You have to have decent walls. You can't have holes in the walls. You can't have broken glass. You can't have peeling paint. They want the house to be in a decent condition. Does that mean it can't be a fixer-upper? No, it can be, but it has to be a cosmetic fixer-upper, not a total tear down. If they find that something's not working, they'll call it out on the appraisal. Mm-hmm. And then the seller will be required to fix that. And then the appraiser will be required to go back out and perform what's called a 1004D, which is a reinspection of the appraisal to prove that the things are done. FHA, if there's significant roof damage or termite damage or pest damage, which in our area, dry rot is a big deal.
Right.
That is considered a pest. As a microorganism that eats the wood. Peeling paint. Let's just say it's a detached garage with peeling paint on the siding. Those are big deals, and those have to be fixed. If we have a good listing agent, those things will be fixed before we get into escrow. If not, we can ask for repairs and ask those things to be done. It's not something that can't be overcome. It does out maybe potentially add a little challenge, but when you have a good real estate agent, a good escrow officer, and a good lender, they can completely be overcome.
Yep, absolutely. So just a takeaway from that. So that means if there's, and we're talking FHA CalHFA, okay, in those respects. So for example, if there's a dishwasher in the house, because not all houses have dishwashers, then it needs to work.
Correct.
And that just happened with one of my clients just a few months ago. And the dishwasher didn't work. So we had to call it out and they got it fixed and we were able to close. Let's see what else. I think you mentioned heating and air, right? HVAC. Go ahead.
Commonly in our area is a stove. So if it's a slide-in stove with like a little backsplash, that's considered personal property. If it's a built-in stove and oven, meaning it doesn't have that, it has a cooktop and it's a separate unit, that is considered part of the house and must work.
Yep, and it must work, right?
Yep.
But the slide-ins, they don't have to work. The ones that are a big piece, they should.
They should, sometimes that gets a little sketchy on whether the appraiser is going to call it, and or if it even needs to be there, because that's considered personal property.
Yes. If you're a seller, just make sure it's working, or at least list it out that it's not working, so you don't get into the middle of an escrow and things get crazy. Yeah, exactly. HVAC. If you are FHA or CalHFA, you don't have to have HVAC, right? But if you do, it has to be working.
Correct.
Okay. You said like garbage disposal. I'm trying to think of anything else.
If the roof is another big one in our area.
Roof, yes. Roof. It has to be structurally sound and safe. Yes.
For any loan.
Yes. And
doesn't matter, any loan.
Right. And so sometimes, and I'm glad you talked about this a little bit, dry rot is huge, but a lot of times that's a quick fix. So, and also sellers, please, if your realtor that's listing your home is hinting that your house, you have some parts that need to be painted because they're eaves or something like that, just do it. Do it so it doesn't get called out. I mean, it's also an easy fix-ish, but that's harder on you, and that could happen with an escrow. So that leads me to one last thing I want to make sure that we mention, and that is when you're a first home buyer, if you are using an FHA loan, not all sellers, when they sell their home, have to accept that loan. They don't have to accept. They could just say we're only accepting cash, period, on our house. So they actually have the right to say, this is what we're accepting. So are there any differences on that, Melanie?
So traditionally, no, let me rephrase that. Historically, FHA loans, VA loans were not as appealing to sellers. Obviously a cash deal would be first because they're getting cash, and most of those loans close. I mean, most of those deals are closed in 10, 15 days. It's very difficult to compete with that. Then would be conventional because they consider that a 20% down, if somebody's putting 20% down on the house, that's more likely to get approved.
Right.
And then it would be FHA from there. It's historically thought that an FHA loan may be less than desirable because of bad credit or only putting 3.5% down. Same with VA. VA is 0 down for our veterans, and any seller that won't consider a VA loan needs to think about what our vets do to our country.
Right.
I'm putting that nicely because that's a passion for me. My dad was a vet. Both of my grandfathers were in World War II and saw very active combat battles. So vets are very passionate for me. But the sellers sometimes think of those loans as less than, and that is 100%, 150% not the case. So FHA buyers can have 720 credit scores. FHA buyers can have 780 credit scores,
Yep.
but maybe their employment is a little different, and maybe their debt to income ratio, meaning their total debt versus total income, is a little outside what conventional programs allow. That doesn't mean you can't buy a house. It doesn't mean you
Right.
don't deserve to buy a home. It just means it falls into a different bucket and different criteria.
Yep.
So I'm very big. I started doing FHA loans in 2007. At that time, nobody did FHA loans in our area, and I made a little joke that said, "Which loan would you prefer, FHA or FHA?" And I had no idea how true that would become, because 2007, 2008, 2009,
Mm,
unless you had 740 credit scores with 20% down, you weren't getting a conventional loan.
right.
It was all FHA. So it's not a bad thing. It's just an alternative.
Right. Now, all of that said, I do want to encourage all of you that if you see a home and your realtor tells you that it's not FHA eligible based on what the listing agent is saying, if you are really interested in the home, your realtor should be reaching out to that listing agent. I do that for my clients. Even though they say I have listing after listing that will say it's not eligible for FHA. So I reach out to the listing agents, and I'm going to tell you why. Because I want to know why it's not eligible for FHA.
Yep,
I want
me
to
too.
know, is it because the house is not structurally sound or safe? Is that the reason? Fine. I don't want my first home buyers going after something like that anyway, right? So I want to protect them. I'm looking out for them. But if they say, it's just really my seller's just not really into accepting that type of loan, then I'm able to share with that listing agent more about my buyers and how they're pre-approved and they're ready to go and they're excited, and I tell them why they're so interested in that home. And you know what? I have a listing agent. In fact, today I have a listing agent who is already talking to her seller, and her seller is I heard back today that the seller is going to entertain an FHA offer when they originally said no. So, woo! So make sure your realtor's doing that for you.
So I have two things to say about that.
Yes,
There are
please.
a lot of really, really, really lazy agents out there. If your agent isn't advocating for you, if your agent isn't showing you a home that may or may not be FHA eligible, let me determine that. Let me decide if it's going to work. I'm the one that knows the loan criteria better than
Yeah.
any agent out there. Like I said, I've been doing this for 18 years. But in addition to that, let's say it's not FHA available. There is a program called a 203K, which is an FHA renovation loan. They have
Ooh.
not been popular for the last couple of years, but let's say there is structural damage and the house is really cheap on the market. We might be able to get 20, 30,000 in renovation financing to help for those repairs and get our clients a good deal and still get into that FHA loan.
Yes. Yes, yes, yes. I just wanted to make sure people knew that don't take no for an answer
Until
unless
no
you
is
find
no.
out more about why, and sometimes you're going to have a seller that's hell-bent on saying no, but that's okay. Maybe they're saving you a huge headache and the right home is just right around the corner. So I think we have shared so much with everybody, and we could probably be talking about this for hours more.
Hours.
I do want to share with everybody that I do have a buyer's roadmap that I like to share. So if you are interested in that, please reach out to me. Not sure if I could just pull it up really quick on the screen. Yeah, it's not wanting to show up for me real quick. So, but I will be more than happy to send that out. In fact, I will put that link in the comments in just a little bit, and then you can go ahead and click on it and print it out for yourself and share it with anybody you know who is a first home buyer. And what it does is it just helps you. Actually, I have one right here, I think. Oh, look at me. I'm so quick. Hopefully I have it in here. Yes, I do. This is what it'll look like. Check that out. You see that? It
I've
almost
seen that
looks like
graphic.
a
It's
board
amazing.
game. Yeah, right? Looks kind of like a board game, but what it does is it helps you walk through the process. So I will drop that link into the comments and you can check it out. I'm sure if Melanie thinks of anything great for you, any great resources, she could drop those into the comment too. And you can check those out. But please reach out to us anytime you have any questions. Well, thanks, Melanie. I hope you enjoy the rest of your time in Mexico in your honeymoon bliss. And thanks for taking time out of your honeymoon to help our first home buyers. We appreciate you.
I'll be back in cold, rainy Sacramento in a week. So I'm looking forward to it, but not looking forward to it, right? It's like kind of like that double-edged sword.
Okay, well, thanks so much, everybody. It has been a pleasure to be sharing so much information with all of you with Melanie, and I look forward to having you back in a couple of weeks on our next episode of Let's Talk Shop.
I'll be home by then. All right,
Right
guys.
on.
Thank you.
Thanks, everybody. Bye-bye.
Bye-bye.